there are talks right now about 208 million Americans having access to a massive stimulus. This is a stimulus that we have never seen before here in the United States. And I've talked about this the past couple of days and mentioned how this stimulus could actually hurt the economy, and it will hurt lower income and some lower to middle income households. The number one reason why is because you will only get this stimulus if you own a home that has equity. So I want to break down what's going on right now. I will give you an actual example of what somebody told me and how this stimulus could actually save them over $1,000 per month. So I'll break that down in just a moment. But all I ask is first, if you like this, do one thing. It takes 2 seconds. Go ahead, hit that like button if you enjoy these daily updates. And now let's begin. So when I talked about this just the other day, I mentioned how this massive stimulus could really help millions and millions of Americans. But at the same time, it could actually hurt millions and millions of Americans as well. Here's the reason why. The one article that I showed you was from Business Insider. It's this one right here. It says the U.S. could give homeowners a $980 billion stimulus at no additional cost. Well, actually, it's not $900 billion. Some were saying it could go as much as $2 trillion. Even from this exact same article, it says as early as this summer, a proposed move could begin to unleash almost $1 trillion into consumers' wallets. By the autumn, it could be on its way to $2 trillion. Well, guess what? That same person, that's Meredith Whitney, she says $3 trillion could be injected into the U.S. economy without any federal spending by tweaking this corner of the mortgage market. Here's what you need to understand. The amount of money sitting in equity is at record levels. Look at this. Americans are sitting on a record amount of tappable home equity at $11 trillion. Okay? That's how much cash is being trapped in your home's equity. So if you own a home or not, you need to pay attention. This is going to impact you. Here's why. I was talking to an expert just the other day. I'm not going to say who it is or where he's from, okay, just to protect him. But I was talking to him, and he said this is the concern, and this whole situation with Freddie Mac coming out and proposing that they get into the secondary mortgage market. This isn't new. This happened before. But the reason why they want to do this now is because they see the potential. They understand that, number one, they could make some money off this. Okay? Number two, this is a huge, huge market. Okay? Billions, trillions of dollars could come from this. But what he was saying is that one of the main reasons why people are looking at the secondary market is because of one factor. Banks are not lending to people right now on the secondary market. They don't want a second mortgage because of what happened back in 2007. I want to show you something. It says a housing proposal could unlock nearly $1 trillion for homeowners. The idea is for Freddie Mac to start purchasing secondary mortgages, offering a cost-effective way for borrowers to tap equity. The reason why it hasn't happened yet, it says homeowners face few options to do this as there aren't many willing buyers. Not only do you have to have a willing buyer, but you have to have the right credit. You have to have the right situation. I want to give you get a quick little example here. This is what somebody commented. And they asked if a HELOC would help. A HELOC is a home equity line of credit, which is essentially a secondary mortgage. But this is what they said. I have a $400,000 home with a mortgage of just $150,000. I also have $40,000 in debt from 2 credit cards, 2 partial car loans, and a little bit of medical debt. My current payment for my cars is $548 a month. My 2 credit cards cost both $135 a month each. They're $270. and I have a total of $10,000 in credit card debt. I also have just under $13,000 in medical bills, which cost $760 a month. So right now I pay a little bit over $157, or no, I pay a little bit over $1,570 a month. Okay. So then they asked, would a secondary mortgage help me here? And this is where I responded. I said, yes, a HELOC would help. It would likely bring your payment down to $350 a month if you had a 10% APR. Now, I'm not a financial expert. I'm a mortgage broker. I'm nothing. Just a guy on YouTube. But here's the thing: you add up all these payments, your 2 credit cards. You add up your 2 partial car payments, right? 2 partial car payments. Yeah, there's 4 payments there. You do medical bills, 5. Yeah, there you go. 5 payments. 5 different payments right now, and they pay about $1,570 a month. So if you go and get a home equity line of credit and you take out some of the equity, so let's say you take out $40,000, that would bring your payment to about $350 because now you are backing that debt with your personal property, with your home. Okay? Right? Great. So I'm going to say about $1,200 a month. It's perfect, right? There's no way that could go wrong. Here's the thing. When you are sitting on a record $11 trillion in home equity, this will go wrong. Guarantee. Here's the reason why this could go wrong. Some people, and it's a great way to leverage your equity, is they go get a home equity line of credit and they use that home equity to buy another property, a second home. Maybe they go and buy an investment property. Personally, I wouldn't buy a second home with a home equity line of credit. Would I go and buy an investment property? Yeah, I would do that. But if you don't know what you're doing, if you don't have extra cash sitting in the bank just in case, I would never go and do that. This is where some could be screwed. If you go and you tap your home's equity and you take out, let's say, $100,000 in equity, first off, what it's going to do is as you spend it in the economy, you spend $11 trillion in the economy. Or let's just say the tappable home equity is at $11 trillion. Okay, right here. Banks and Freddie Mac are not going to give you 100% of your equity. They're not going to pull it out like they did back in 2007. No. What they're going to do is they'll say, okay, well, I'll give you up to 80%. So if you have a $400,000 house, you could get as much as $320,000. That would include any equity out plus your original mortgage. Okay. So let's say instead of $11 trillion, it's $8 trillion that we can get out. Remember, we spent what, $7 trillion during the pandemic. It was a little more than that, I believe. But we spent trillions and trillions of dollars. That caused a massive run-up with inflation because it was stimulus. So if all these people are now afforded the opportunity to go and get some of their equity out of their home, it is going to stimulate the economy. Here's the reason why it's a problem. For the low income and middle to low income households that do not own a home and cannot access their equity, guess what? They will be royally screwed. Because as people go and buy a second home, they go and buy an apartment building, they go and buy a new car with their home equity line of credit. Because again, let's say you only have a 10% APR. Maybe that's less than what it would be if you went to get a car loan. Okay? So you're going to go and do this, and again, it's going to bring your car payment down, right? You're not going to have a car payment. You just pay the car in cash, right? So all these people are going to look at all these other scenarios. They're going to go on vacation, buy a new car. They're going to, update their kitchen, which doesn't bring you in any money. Updating your car doesn't bring you in any money. Going on vacation, again, doesn't bring you in any money. I would only use a HELOC if I was going to go and buy another investment property. That is it. Okay? But people are going to pay off debt. Okay, I understand. They're going to go buy a new car. Now, probably not a good idea. go on vacation because they have a little bit of money. They can do it now. Right? It's cheaper to go and use the HELOC to go on vacation than it is to use a credit card at 20%. Right? So they're going to spend like they've never spent before. They're going to use all the equity in their home. Okay? They're going to pull from the polling period or whatever, right? And then they're going to have to pay off this loan for however many months. The problem is, and this is a major problem, is that if we go and tap all the equity that there is right now in the home equity market, we will be screwed. We will be screwed because inflation's going to go up. And if inflation goes up, we could see prices for homes go up as well. But again, it's not going to be great for the low income and the middle to low income households. Those are the ones that are going to feel the impacts the most because they have nothing that they can pull from. So again, this is a massive stimulus. This could really impact the markets. This could really impact the US, but at the same time, it could also impact us negatively. So we'll see what happens, but I just wanted to share this with you and give you this one person's example because there are times where, yes, it makes sense. If you can save $1,200 a month by getting a HELOC, okay, consolidating all your debts, paying them off, and now you only have a $350 payment instead of a almost $1,600 payment, that makes sense. But doing this so that you have more money to spend to go get a car, go on vacation, right? Remodel your home, paint your house, put a new roof on. It's probably not the best thing. So I will leave you with that. But as of today, that is what we know. So again, thank you guys for watching. Consider subscribing. And I'll see you guys on the next one.